All right, we've got Amish Shah joining us this morning, India equity strategist at BofA Securities. Amish, good morning. I was looking at some of the comments on the strategy and how you're really looking at Make in India gaining momentum, the government's CAPEX push, starting to have an impact there and turning positive on industrials, materials. That's interesting because we were just in fact discussing that this morning and have been speaking to several companies, particularly on the Make in India push. Tell us about the thought process there, and within that perhaps any stocks or narrowed down themes that you're looking at.
Sure. Thanks for having me on your show. Good morning, everyone. So I would say that Make in India as a theme has been around for a very long time, and there are skeptics around those too, because in the past, the scheme has not worked. There has been a big lag. But this time around, why are we that confident? I would probably highlight three things really. So number one, I would say that this time around, the government is really working in a targeted fashion to address the factors of production, specifically the issues related to factors of industrial production, which is land, labor, power, access to cheap capital, logistics infrastructure. So all of these has been issues in the past. The government's working on it. We are also rapidly trying to curtail our $51 billion trade deficit with China. And then, you would also see that every global company is really looking at China plus one manufacturing strategy. On that, we had done a global survey recently for all the companies that we cover globally. And what we learned is around 75% of the companies are contemplating on seriously having a China plus one production strategy. So if this really goes through, plus the targeted efforts that the government is putting in, I really think that it falls in some success in terms of Make in India at this point in time. Coming to the sectors that you mentioned, particularly within the Make in India theme, we are very confident that the success we saw within mobile phones will now translate into broader consumer electronics category, which is all the white goods, televisions, so on and so forth. We also think that this will be reasonably successful in pharma. We also think that this will be successful for coal sector. While coal is not so much of an export-led sector, but there's a $23 billion of imports that we do every year for coal, and that we think can be curtailed. And then subsequently, if the theme accelerates to more reforms, as you were just highlighting on your channel, for more reforms within defense, maybe the production-linked scheme expands to textiles. We do think that it could probably continue to spread across more sectors this time.
Okay, fantastic. What about metals? Where do they lie on the overall scheme of things? How much of room do you feel there is, and near-term risk as well?
So metals is connected with the Make in India and the infrastructure push theme. Clearly infrastructure is a big driver of the demand for metals. Plus, at this point in time, there is consolidation happening for sure. So a lot of the marginal, smaller metal companies are not able to scale up. The big companies are gaining market share. Plus, the spread of margins that you have within the steel companies is actually accelerating in India as compared to that in China. So all of that put together is already in a quite comfortable zone. And if the Make in India story accelerates, plus there is a talk of government giving a push towards more infrastructure CAPEX, if both of that comes together, we do think that there could be reasonably good rally within the metal sector and broadly the material sector, including cement as well.
Sure. Amish, lots has been said about how there is a chance that NPAs are going to balloon once the moratorium gets lifted, and only that's when the real picture with the NPA stress on the books is going to come to light. However, do you believe that right now is the time to actually buy into banks when the prices are suppressed?
Absolutely. So I would say that if you look at the top 4 private banks in India right now, especially after the capital raise that they have done, their capital ratios are fantastic. In fact, we put out a report today from the banking team that says the capital ratios for the private banks are now the best in the emerging markets. and on the back of this capital raise. And amongst these top four banks, you now have 8% to 10% of NPA coverage ratio if it were to happen. Not that we do believe that the NPA ratios could be that high. But you're right that the markets might probably wait for a couple of months, to get clarity on what kind of NPAs or loan restructurings really come through, and the rally may start only on the back of that. But we are positive on a few private sector financial companies. We clearly think that they are really well capitalized. If the NPAs don't turn up as much as one worries about, then they have adequate capital for a good runway of growth, either right up to 25, 26, or probably this is a capital available for inorganic growth as well.
Sure. Would you say the same about autos, although the prices have moved much, not suppressed, as is the case with the banking names? Auto ancillaries, autos, we were just looking at the ad sales data as well, and the kind of reports that are coming in wherein they see a huge spike come in the second half, owing to the onset of the festive season as well. Do you believe there is still a meaty chance to get into autos or auto ancillaries for that matter for the long haul?
For a short term, yes, but unfortunately, we are not so positive on anything discretionary at this point in time. And autos, consumer, some of the consumer discretionary fits in there. In general, if you look at the retail credit growth at this point in time, which is one of the key drivers for anything discretionary, that is coming off. You would have seen that the retail credit growth is down to 10%. It used to be 17 prior to COVID. And even the commentary or the outlook that you hear from the retail lenders is not that upbeat. Combine that with the fact that recently we looked at 240 companies within NSE 500 that have reported earnings so far. Everybody is talking about curtailing costs. The overheads of these 240 companies right now is down by about 25% YOY. Of course, some of these costs were transitory and may rebound, but then some of these costs will be structural. And while it is positive for earnings of these companies that are cutting the cost, on the other hand, it means more job losses, more income losses widely in general. Combined with the fact that retail credit is tougher to get now, we think that the volumes that the discretionary stocks saw in FY19 may now be back only by FY23. So if you're going to have almost like a flattish volume over 3-4 year period, especially in the context of where these stocks are trading currently, we are not very upbeat on discretionary stocks or the auto space in general.
Talk about financials. I know you're underweight, but let's talk about the rationale behind that as well, Amish. Is it a valuation strategy? Is it the fact that you're concerned perhaps on the NPA front, or you just see better opportunity elsewhere?
Actually, we are not underweight financials, but as I said, to the point that you made too, that we think that the markets will wait for a couple of months for the clarity to emerge on what is a quantum of loan restructuring or NPAs that comes up. If the numbers are not too high, then we do think that private sector financials, particularly, it does have a pretty good scope of taking the market rally forward. So we are not conservative on that space, but we are just waiting for a couple of months for the clarity to emerge, in order to go all out.
Sure. It also seems that more than earnings, the markets are really going to be, tracking, positive commentary, indicators of growth, orders, and positive moves ahead in that respect. Because, but how much of that do you feel, to some extent, is priced in?
Do you mean for industrial stocks now?
Yeah, because there is some amount of consolidation that's anticipated. Is this, let's say in the next 1 year, can we expect multifold returns? We've already seen the index looking pretty strong so far, but going forward, do you see broader markets start to perform? Do you see consolidation? What do you feel will be the trend?
Sure. For the broader market, we were actually quite beat over the last few months, but now recently we are talking about markets consolidating for a while. If you look at on a bottom-up sector basis, so some of the large sectors like IT, pharma, telecom, which is about 44-45% of the index weight, they have done really well. And unfortunately, the valuations do not have a lot of room for further re-rating going forward. So we do think that those stocks may take a breather now. Financials, which is other large sector in the index, for the next couple of months, as I said, we do think that the markets will wait for clarity to emerge on NPAs or loan restructuring. So they may not immediately perform near term. On the other hand, on the positive side, we have upgraded or increased our weights for industrials, materials, logistics sectors. We are already overweight on staples. But all of that put together is more like 20% weight in the markets. So when you look at it on a bottom-up basis, I do think that the markets may take a breather for some, and it would financial stocks a few months later.
All right, we'll let you go on that note. Appreciate you taking the time, Amish, and joining in, giving us a flavor of the markets as well as your outlook.